Now we get to turn towards some good things that are happening in the market right now. Obviously, we've talked about PMI getting better within the U.S. It's something that's supporting. Jobs have been a problem, continue to be a problem, especially when we look at hours worked. But there's other sides to the equation when we look at CPI and just prices overall, and we'll cover this in the next segment as well, looking at Europe. But before we dive in, we'd just like to remind you, please like, share, subscribe. And just a reminder, we do have our big report coming out next week. So please reach out to learn more. We can send you just a quick index of what's in it, see if it's something of interest, and please let us know, because you get to hear these rantings or read the rantings of me on China and NGLs in a bit more depth. So now that we look at goods and services, and it's important to separate, where things are happening. I just to give you an anecdotal story and not to bore you with it, but when I went to BJ's on Saturday, after Thanksgiving, trying to get food and things for the family, I went to go buy paper towels, and typically, and someone because I love the Price is Right, I think I would do very well. If anybody's watching and wants to go on with me, I'd love to. But when we look at what's happening, I used to buy this specific Bounty package was $17. When I bought it was $31. I bought toilet paper that was normally $20. It was close to $40. These are the problems that people are experiencing, and this is just looking at goods and services in different directions. So when we look at CPI commodities, not including food and energy, we're looking at things increasing. And then services, X energy, you can see just the different backdrops in terms of pressure on prices and pressure on spending, because the things that people spend money on have gone up, and things that people don't spend money on as much, like durable, like things that are less replaceable and more replaceable, people are just spending less. So that's pushing prices down. Now, while we see these prices increasing, disposable income is also coming under pressure. With a very large unemployment pool, prices can come down for salaries, for benefits. These are problems if you had a job that was $100,000 and you've been unemployed for 26 weeks, will you accept a job for 75? And the answer is probably yes. And if you accept one for 75 and some of these prices continue to go higher, that's squeezing you more. And now diesel prices continue to be very low, which has been supportive, which we'll talk about because the European chart does a good job of highlighting that. Diesel prices have been fairly good for the consumer, the gasoline prices. So whenever you hear, central banks talk about, oh, well, inflation's so low, it's like, well, diesel prices are down 8%. Gasoline prices are down 4.5%. If those adjust, guess what? Inflation isn't so low, and all of a sudden prices go up. So, the running joke, as I said on Twitter, was, at what point does central banks start just, declaring what price gasoline and diesel should be to get the so-called inflation that they desire? As you can see, for some things, it's already there and rising. And that's why we like to look at that and separate the different things. But now, U.S. construction on a commercial side remains under pressure. On a residential side, just continuing to off to the races. Just the residential building, U.S. construction spending. Again, here you can see, spending was up 1.3%. U.S. construction spending, again, complete recovery from the lows, and this is a positive. It's less on the commercial side, more on the residential side. And think about it. People, again, moving from urban to suburban, people wanting home offices, but not having to go into a city, but not wanting that be in the house and having some place to go. There are things that are going to remain fairly strong, and the U.S. construction side, is going to continue to be one of those bright spots. Now, when we look at pending sales and total existing home sales, again, everything remains fairly strong. So pending sales, advanced by 1 month, have come down a little bit, but you have to consider there is seasonality, there's a certain delay in terms of people getting mortgages, but total existing home sales continue to be up and to the right. Again, this is supporting why people are new construction, new permits. The issue that we've talked about, especially in the previous segment and then in other segments prior, how does this change when we get foreclosures and evictions coming back out? Because then there'll be some short sales. There'll be some things coming in that would essentially add to the total volume available, which I think will put additional pressure on some prices. But again, with rates as low as they are, prices may come down, but as long as rates are here, you'll continue to see that pass through. Now, when we look at bankruptcies overall, on a positive level, November was the slowest pace for 2020, which again, as things starting to normalize, we saw May, June, July being some of the worst in terms of bankruptcy filings, and things really started to slow down. Now, so far, just to kind of put it into context as to how does 2020 look like compared to other years. So there have been 228 bankruptcy filings year to date by companies with more than 50 million in liabilities. In 2009, there were 275 in the comparable period. So again, we're still very elevated, near where things were in the financial recession. But again, things are starting to slow down. And it's because people, as PPP money ran out, as stimulus clearly wasn't coming, people made the decision in July, look, restructure now, get it over with. Let's just, try to get things normalized. So it makes sense to see some of that slowdown. And as people look to, okay, let's just try to get through November, let's try to get through December, and then see what 2021 looks like, which is why we should continue to see some slowdowns into November, December. And then as we've talked about in previous shows, I think it was last week, we actually showed where there's a huge slug of bonds coming due. And March is actually a very big month. So that's something where people could start to say, look, I'm getting to March. I have these bonds due. I'm not going to be able to pay the interest. Let's go into restructuring, which is why, we should see a slowdown. And if you look at 2019, typically there's that slowdown in November and December, and then January, February, and specifically March, we should see another increase. Now, when we look at the amount of debt sitting out there, it continues to shrink. So the total amount of distressed bonds and loans traded shrank 13% to about $200 billion on November 27th, as of last week, which is down from $935 billion in March. So again, we were almost near $1 trillion. We're now down to 200, and the volume of distressed bonds declined 11.4%, while troubled loans dropped to 16.6%. To give you an idea of kind of what those numbers look like, the trend has been moving in the right direction. The problem is, as we get to the other side and stimulus starts to come back, and we start to see a consumer that's struggling, how much revenue really rejuvenates. And not to say that this ticks back up, but does it continue to get better, or do we see some, a movement closer to the July levels as people were looking like we got to this point, we got to the other side. Now let's start to ramp up. Let's start to try to push through some initiatives, and they're going to have to borrow. They're going to have to raise their debt ceilings in order to get some new juice and some new stimulus for the company, which again was just going to stress balance sheets. And as balance sheets get stressed, then these numbers start to increase. Again, still a positive trend, still a positive move, and just showing some semblance of normalcy on the other side. But then, as we said last week with zombie companies, or the last week and the week before, zombie companies continue to be kind of that hidden landmine in the middle of kind of where things could shake out on a corporate level and problems that are going to reside. And, we continue to see more about student loan forgiveness, and we like to think about, well, what does this mean for spending? What does this mean for investment? And when you look at the share of borrowers with student loans, and we'd never like to get political. We never like to we would try to be as agnostic and just show the data and try to explain what that data means. You can see that the share of people that have student debt is at the high income, mid-income level. So again, those individuals would get an outsized benefit. And how many people on the low income side went to state school instead of the school of their desire or the school they got into because they couldn't afford it. So even their benefit, they might not get the same amount. And you could say that on a percentage level, a low income forgiveness means more to high income, which is very, very true. And this is just percentages. It's not the actual numbers. So there could be that, but it's still going to be more for the higher income. And if we look at just the ethnicity on a majority white mixed, you can see just in terms of who gets the biggest benefit if we get this forgiveness. Now, as we look at trickle down, as we look at spending, these are also individuals that spend the most. When we look at high income earners and who spends, they're the biggest spenders. So if you give them extra capital, they'll go and invest. They'll go and buy stuff in the stock market, because we all know we need the stock market to go higher. They'll do things to help stimulate the economy. So you kind of get both sides of the equation. And then if they're buying more than those who work hourly, which happen to be more on the majority Black and majority Hispanic, will see their hours increase and their income increase. So you can get it on all sides. It's just what does this mean? Like, who missed out on opportunities? Does this have ramifications? Does the next time debt gets out of hand, they'll say, oh, we'll just forgive it. There's a moral hazard behind it all, which I think needs to be appreciated when we're talking about forgiving debt at these levels. Like, maybe cut interest rates. I'm charging you 7%. I'm now going to charge you 2%. I'm charging you 4%. I'm going to charge you 1.5%. Maybe make it less onerous on an interest rate level and not forgive the principal. There are things that we can do to make this normalized without just throwing stupid cash at it. And because you're still going to have to borrow to pay it off, and because there's assets and liabilities you got to offset. So this is something to consider when we're looking at this specific topic. Now, when we look at kind of falling back into where is that spending, due to expire December 26th is the pandemic unemployment assistance, the pandemic emergency unemployment compensation. And you can see just the sheer size of it. Let's call it 13.6 million, 13.7 million will lose benefits as of December 26th. The current stimulus deal out in Congress right now would extend that for a month. So that takes you to January 26th. Getting you closer to inauguration, hopefully some adjustments, and maybe they're looking to try to just kick the can. But again, this is going to impact spending. The people are relying on this money, and it is set to go away in the next few weeks, which would be an outsized problem, especially as we go into January. And another reason why we need to be concerned about what does GDP look like as we go into the new year. And now just kind of rounding it out, and as we go into Europe in the next segment, this is just looking at total daily total card spending based on Bank of America aggregate card data. You can see that we're back at strong levels, which is a solid start to the season. Obviously we had a big drop off, and it's just showing you that total cards in general are increasing overall. And this is looking at retail sales in general. This is looking at card present and not present. And what does that mean? Card present means that you physically swipe the card in a store. Card not present means that you did it online and you plugged in your numbers. So this is looking where so far things are off to a solid start, and we're hopefully that this means that we're going to see another nice little pop as we go into December. The question is how much are people taking advantage of Black Friday sales and other types of sales that typically happen starting Black Friday through maybe the first week of December. That was pulled forward. We saw more sales in November, more sales into the end of November, and then obviously increase into December, which could pull and shift purchasing and sales overall, again, which is a net positive, but let's see what kind of follow through we get. And now we get to, in the next segment, we get to jump into the euro and the US dollar and some of my favorite topics as the US dollar weakens and the euro strengthens, and what does that mean for the European recovery, or at least what the stimulus they're trying to accomplish.